Are bond traders settling for too little just as risks begin to build? Fixed income investors are starved for return. Roughly 90% of global bonds yield less than 5%, and even traditionally safe assets like treasuries have offered slim rewards. That may have made sense when the economy was rebuilding, but growth is running hot and credit stress is increasing. Are bond markets underpricing the risks ahead? Laura Cooper is head of macro credit at Nuveen. So Laura, let's start with today's GDP and PCE numbers. Will they reinforce that the US economy is running hotter and add even more pressure on bond returns?
So the underlying narrative is likely to still be that the US economy is running resilient. We do expect that to materialize in the GDP print, even though that's going to capture that period of that prolonged US government shutdown. We're still expecting a quarterly pace above 3%. I think the market attention, though, will largely be on that inflation gauge, the Fed's preferred inflation gauge coming out today. And that's likely to show that price pressures do continue to remain persistent. Now, the Fed did acknowledge in their last meeting that they do expect upward pressures, largely to be a one-off factor. But I still think that investors are really becoming more attuned to the risks that inflation could actually remain elevated for a prolonged period of time.
Well, traders are piling into bets that yields will fall, with one position targeting the 10-year yield to move back below 4%. Do you see that as realistic?
I think that's not necessarily a near-term kind of forecast for us, and that's largely reflective of the fact that inflation risks, like I mentioned, do still remain. And I think we're still in this backdrop where growth remains resilient. That's not going to keep the Fed on this aggressive easing cycle. If anything, we think we're going to be in this extended policy pause with perhaps a couple of cuts coming through by the end of the year. I think we are seeing these bouts of bids for US Treasuries, and that's largely on the back of escalating geopolitical risks, but not sufficient enough to have a material bid for bonds against this backdrop where we aren't seeing a significant deterioration in the economic data.
Well, let's zoom out, and China has been steadily reducing its treasury holdings. Does that pose a structural risk to the $30 trillion US bond market?
I think that really reflects more of a long-term trend. We have seen this rotation away from holdings of US Treasuries by the China government for quite some time. So this isn't necessarily a catalyst for a more material move, if anything. I think it does just capture the fact that we are in this elevated, higher for longer yield backdrop, and that does warrant investors to really rethink some of their fixed income allocations. Perhaps digging a bit deeper for diversification, looking for more of those up in quality corporate bonds rather than just taking on those exposures in the rate space.
Let's talk corporate bonds now. And AI-linked companies fueled convertible issuance to record levels last year. Will you see that momentum continue even if a broader risk-off sentiment moves over the market?
Well, we certainly are seeing issuance be quite ample, to your point, to start the year. And we do suspect that's going to be a trend that continues to prevail through this year. We are seeing pockets of risks, to your point, emerge in the credit space. But I think this is largely opening up opportunities. We are seeing investors really have this indiscriminate sell-off, particularly driven by that software space. But to our mind, this is going to really be more of a selective environment for active managers, really finding those winners amongst really what we're seeing is investors just shedding their credit exposures at this juncture, which we feel is not warranted across the board.
So finally, Lord, let's dig deeper into these private credit fears. They're facing a new test after Blue Oil Capital restricted withdrawals from its retail debt funds. Is this just an isolated case?
I think we're going to see more bouts of these risk episodes emerge. I think there's certainly been this massive expansion of private credit over the past number of years. And so we are going to see more of these episodes emerge, but that's not necessarily a reason for investors to shun the asset class. If anything, what we are seeing is that private credit is becoming that core institutional portfolio holding. And I think that just adds this broader case for diversification across portfolios. So really looking across the public-private spectrum for opportunities and perhaps avoiding some of these idiosyncratic factors emerging that we think are going to come up more and more in the coming quarters.
That was Laura Cooper from Nuveen. Don't forget, you can watch more videos on Reuters.com.